Welcome, everyone, to this December 2023 review of the six air taxi companies traded on the US stock market. This review covers the month of November 2023. Now, this monthly roundup series strips away the fluff, cuts through the noise, and provides clear sector information so you can make educated decisions. We will review the publicly traded air taxi companies, so without further ado, buckle up and let's get started. So let's start with some general information here. Our bucket of companies are Archer Aviation, EHang, Eve Air Mobility, Vertical Aerospace, Joby, and LILM. I wanted to stop at the sticker, EVTL, and I want you to read it, EVTOL. Now, you will hear this term, EVTOL, a lot when it comes to air taxis and advanced air mobility. And EVTOL stands for Electric Vertical Takeoff and Landing. It is the ability to take off and land vertically, just like a helicopter, but using electric propulsion rather than jet engines or turbines. This chart adds the industry. Now, all these companies are industrials, and all except Joby are in the aerospace and defense sub-industry. Joby is categorized as airline because Joby intends to build and operate their own aerial ride-sharing network in an Uber of the air fashion, if you will. Keep that in mind as we go through the presentation because this will explain some aspects specific to Joby. Archer and Joby are US based. We have one company from China, one from Brazil, one from the UK, and one from Germany. Here's the model name. Not that important, but it's nice to know whenever it's available. Use case means the intended application for the aircraft. Urban air taxi is one of them, and it is important to start familiarizing yourself with the following acronym, AAM, Advanced Air Mobility. Air taxis are a subset of advanced air mobility, and as more companies go public, we will see use cases that are not air taxis. The range in miles is the distance the aircraft is supposed to fly. Now, these numbers may have different bases, with battery reserve, without battery reserve, and they may not be 100% accurate, but they provide a good order of magnitude about the aircraft capability. The unit price is the list price of a model and is self-explanatory. Now, this is extracted from known and public information coming from signed contracts or deals, what executives may have announced in public settings like conferences or found in letters to shareholders. When no information is available, you will see a question mark. Now, let's look at some outliers here. The first one is EHang. It is not an urban air taxi. Now, it's important to understand that. The EH216-S is limited by regulation to operate only over sparsely populated areas, meaning not in an urban setting. Also, take note of the range, 19 miles, way below the next value, which is 50 miles for Archer Midnight. The unit price is also a fraction of the others. So, in summary, EHang EH216 is not a competitor of the other models in this list. The second outlier is Joby. Their strategy is to build an aerial ride-sharing service. They are also developing an app-based platform that will enable customers to book rides directly through their service. I want you to think of Joby as a combination of Boeing plus your preferred airline plus Uber or Lyft. This explains why the price of their model is unknown. They do not intend to sell it to commercial operators, so there are no deals to look at. The third outlier is LILM. LILM wants to compete with business jet manufacturers. Their use case is identified as regional business jet. Their list price is also twice that of Archer Midnight, $10 million compared to 5. All right, so now that everyone is baselined, we can move on to the next section. Now, in here, we're going to review what some non-financial news outlets wrote about our bucket of companies. I insist on non-financials because the financial news are available in abundance and they usually do not analyze the technical aspects of an announcement. That's not their job. The format here is the following. The news are categorized as either sales-related, market-related, regulatory, partnerships, etc. The idea here is that in any given month, a company may have done many PRs, but few of them generally are worth anything when it comes to the progress toward commercialization, because that's what matters for shareholders. Is the company making tangible progress towards certification, and is it signing deals and collecting down payments? They can be announcing additions to their teams, partnerships, whatever. At the end of the day, the company needs to certify the EVTOL aircraft and, in parallel, have paying customers that will take delivery of the aircraft and send a check. It's as simple as that. Most of the rest is fluff and noise. We will also mention any market related news that has bearing on our bucket of companies, even if it is about a non publicly traded company. And we have an example in this deck. Let's start with ACHR. So, two sales related announcements, one partnership, and one miscellaneous. And let's focus on the sales related ones, especially the Air Chateau announcement for 100 Midnight aircraft with a down payment of $5 million in two installments, 1 plus 4. Still to be paid, so once the payment is made, the order will be added to my list of firm orders. The Interglobe deal in India did not carry any down payment clause as far as I know, so the Air Chateau deal is a lot more meaningful. EHang is next with three earnings related events, one market related announcement, two partnerships, and two operations, and one miscellaneous. Now, for anything earnings related, unless the earnings contain a bombshell, I assume that you guys know how to read them. And all the companies in this bucket are pre revenue. So there are few items to care about. Now, for EHang, the big event of November was the investigative report released by short seller Hindenburg Research. The main claim of the report is that EHang has an empty order book and is misleading investors. You would think that the specialized media would have paid more attention to the report. Nope. One media outlet covered the report and the coverage was biased. Now, I don't want to spend too much time on this because it needs a lot of time to unpack, so I will refer you to a video on the channel that speaks at length about this. It contains chapters, so feel free to skip as needed. Eve Air Mobility, nothing to mention here except that their comm department has been busy. Vertical Aerospace, two earnings, two partnerships, one operations. We will talk about the $180 million capital raise later. They have a weak balance sheet. We'll get to that, but I will shamelessly refer you to another video on the channel where I speak about the importance of having long-term financial backing. Check it out, folks. The video was recorded quite some time ago, but it is relevant to the vertical aerospace situation. Now, let's move on. Joby continues to be partially funded by the taxpayers, this time $10 million from California. Good for Joby. The main thing I want to talk about here is the regulatory related information that was part of the Q3 earnings. Joby says that they are 84% through Stage 3 certification. And this is a nice graphic extracted from their Q3 shareholders letter. There are 5 stages of certification, and somewhere around the end of Stage 5, the FAA will issue a type certificate, which is the regulatory approval of Joby's design. Without a type certificate, there is no go into the market, therefore no revenue. Now, Joby is aiming for a start of commercial operations in 2025. 2025 has 12 months, and they have not provided an exact time frame because it is difficult to forecast when they will receive the type certificate. And there is still quite some work to be done. Stage 4 is at its beginning, and Stage 5 has not started yet, and both stages take time. So I appreciate Joby's transparency in sharing this timeline, and it is a company that knows what it's doing. It is to me the company that has the program with the furthest progress and will likely be amongst the first to put an air taxi in service. But I'm skeptical of an entry into service in 2025 because it would mean a seamless flight testing campaign, which we all wish for, and an expedited review from the FAA, which we all wish for. But if we learned anything from past aircraft development programs, the combination of both, meaning the seamless flight testing and the expedited review from the FAA, happens extremely rarely, especially for novel programs. And I wish I'm wrong, because the soonest Joby goes to market, the soonest we will collect data on adoption. And adoption is the missing element in this new market. So 84% seems to be high until you put things into perspective. That being said, this chart provides a benchmark about the other companies' progress. If Joby is first, then the others are not at the same progress. I'm thinking especially about ACHR here. So their entry into service is further to the right. LILM, sale of 10 aircraft to Arcos Jet, who is their distributor in the Middle East. Not going to dwell on that. But LILM has an aggressive sales team and they collect pre-deposit payments as much as they can, which is good for shareholders because it's non-dilutive funding. But let's focus on the regulatory PR. So the PR is about LILM receiving an EASA design organization approval. The EASA is the European Aviation Safety Agency. The PR goes on to say that design organization approval, aka DOA, is a core requirement for any commercial aircraft development company, blah, 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 that the award establishes LILM as qualified to design and hold type certificate, blah, blah, blah. EASA is responsible for ensuring safety and environmental protection in air transport in Europe. It is the European counterpart of the US FAA. What this announcement means in plain English is that LILM has the organization, procedures, competencies, resources, and the rigor required to design and, between air quotes, certify aircraft according to the EASA safety standards. But LILM does not have any authority to certify a complete aircraft. The DOA does not in any way, shape, or form guarantee the success of their aircraft certification. It means they can perform compliance work in-house. There are companies who have DOAs and struggle to certify an aircraft. I can think of two: Leonardo Helicopters and Bell Flight. So I'm not trying to diminish this achievement because it is an achievement. I have remotely participated in setting the equivalent of a DOA for the FAA, and trust me, it's a pain in the rear, but the DOA is part of the LILM company story, not the LILM jet certification story. So again, while it is an important achievement, it does not mean that the LILM jet is close to being certified or guarantees the certification of the LILM jet. All right, so I hope this makes sense, folks. Some news here that are unrelated to our bucket of companies but have an impact. Volocopter is a privately owned German EVTOL company, and it is considered by many as the most advanced air taxi company in terms of being first to the market. Volocopter just hit two back-to-back snags. Singapore said thanks but no thanks, and the Paris City Council has some harsh words for Volocopter plans to operate during the 2024 Olympics. Words like absurd, totally useless, and hyper-polluting gadget for a few ultra-privileged people in a hurry. Without the help of officials, it will be very difficult for air taxis to be deployed, and we're not talking yet about the public acceptance. Now, we'll be following Volocopter because the ramifications are important to our bucket of companies. Let's move on to the next section where we will look at some metrics. And the first one will be related to valuation, and it is not a standard metric, okay? So we will look at the total amount of the firm orders as it relates to the market cap. In other words, how much of the current market cap enterprise value, I know they're not strictly the same, but let's assume they're the same just for sake of simplicity. How much is coming from firm orders, and compare the numbers for the bucket of companies. Now, each number by itself in a vacuum means nothing, but when we compare the numbers between the companies, then overvalued and undervalued companies will show up. Now, the question is, why firm orders? Firm orders are orders for a delivery slot or an aircraft that has been reserved for a customer via a deposit payment, and therefore creates a contractual obligation for both the seller and the buyer. Options, contingent orders, are sometimes not worth the paper they're printed on. The lower the TFO over MC, the more overvalued the company is. The higher it is, the more undervalued the company is. So the math is simple. We multiply the number of firm orders by the unit price and divide the total by the market cap to come up with the TFO over MC ratio. Example for Archer, firm orders constitute 26% of its market cap as of December the 3rd. And just as a note, the 100 orders you see here are orders from United Airlines, not the Air Chateau we mentioned earlier, since the Air Chateau $5 million down payment has not been made yet. Now, let's look at the bucket. EHang sits at 4%. Eve, no firm order I can find, so it's an NA. Joby's NA as well, since they will operate their aircraft, so they're not actively selling them for now. LILM sits at 81%. Now remember, the lower the TFO over MC, the more overvalued the company is. The higher it is, the more undervalued the company is. And you can quickly notice a problem with EHang's 4% compared to the next lowest number, 26% for Archer. So this seems to indicate that EHang is overvalued, something the Hindenburg report speaks about. Now, I took all the orders of EHang, firm, conditional, the 1,000 aircraft from United Therapeutics, and added them all up. The ratio jumps to 35%. But then, where is the remaining 65% value coming from? Adding all the orders for Archer, firm, optional, conditional, would bring its ratio to 158%. So when it comes to EHang, Houston, we have a problem. Now, let's look at the current assets because it's important for the companies to have the financial means to execute on development and certification and ultimately bring their aircraft to market. Hands down, Joby has the strongest balance sheet with over $1 billion in cash. Archer is following with 460 million. EHang has $41 million left, which is fine for their low altitude drone program. But if they want to compete against Joby and Archer, they need to raise some serious money. And by serious, we're talking hundreds of millions of dollars, if not a billion, which would mean dilution of current shareholders. And then we have another problem with vertical aerospace. $94 million, and they're not through certification. And remember, they are competing with Joby, Archer, and Eve. So when it comes to vertical aerospace, three words come to mind. It's bad. So what's the big deal? They can raise money, and that's exactly what they're doing. $180 million in mixed securities. The only problem is that their stock is trading so low that they received a continued listing standard notice from NICE. They have been trading below $1 for more than 30 consecutive days. They have a 6-month cure period, otherwise, they will be delisted. The same three words come to mind. True story now. As I was preparing this deck, my youngest daughter, she's 7, saw this chart and asked me what it meant. So I explained to her in basic terms what a capital raise means. And I swear to God, this was her reaction word for word.
Why would somebody be dumb enough to give them that much money?
All right, charts here as of December the 3rd. Real quick, looking at the daily and the weekly charts. Obviously, I'm not a day trader. The daily with the 50-day simple moving average line in blue and the 200-day simple moving average line in red. The weekly with the 30-week simple moving average line in white, and the charts are for a 1-year time frame. Archer is in a clear uptrend, tested and bounced back from the 30-week moving average. Real quick, guys, if you are getting value from this video, please give it a thumbs up and consider subscribing. Also, ring the notification bell so you are notified when the next monthly roundup is released first week of January. Wild ride for EHang here since October, but it's in an uptrend. The ugly red candle on the charts is the gap up after the type certificate announcement and the sell-off that ensued. The short seller report released on November 7 had virtually no effect on the stock. Eve stock is going nowhere. Dead cross on the daily. The 200-day moving average is flat. Now, Eve is held at 80+% by Embraer. Embraer is the third largest aircraft manufacturer in the world. So it is almost a private company quoted on the stock market, if that makes sense. Vertical aerospace. Same three words come to mind. I mean, if you are into fundamental analysis, this chart reflects the story. If you are into technical analysis, the fundamentals correlate with the chart. Vertical aerospace is the convergence of fundamental analysis and technical analysis. The divergence of the two analyses is EHang, where the valuation is divorced from the fundamentals. Joby, weekly in an uptrend, daily going nowhere. Something would need to happen so that the 50-day and the 200-day lines part ways and give us some clarity, either to the upside or to the downside. LILM may be in a stage 1 in the weekly. We'll see if it's able to break out, preferably on some nice volume. And since it's always good to have a perspective, let's look at the compare of prices over a 1-year period. I intentionally trimmed the screenshot at 6 months to provide visibility, but the underlying data is for 1 year. As benchmarks, I'm using the ACHR ETF tracking the aerospace and defense sector and the IWM ETF acting as a proxy for the small caps. EHang is faring very well, followed by Archer and Joby. The three stocks are outperforming ACHR and IWM. Even LILM are underperforming the benchmarks. Vertical aerospace is not showing. I thought at first it was an omission on my side, but after double checking, it did not fit into the scale. So always the same three words when it comes to vertical aerospace. Adding the 52-week range for reference here. I believe this is self-explanatory. Last but not least, short interest. The data is delayed by 15 days, so I will see if I keep it in the deck next time. But between October 31 and November 15, Archer had 1.35 million less shares shorted. All the others had the shorted shares increased, with LILM being the worst performance here. I mean, that's 50% increase from 8 million to 12 million shares shorted in 15 days. I mean, again, the data is 15 days behind. So by the time the video is published, the landscape may be different from what you're seeing on the screen. And just as a disclaimer, this is not investment or divestment advice. You will need to do your own research and invest accordingly. That's it for this roundup. Stay out of trouble and see you in the next video.